Welcome to Dr. Fred Markets. This is not financial advice. The gap between those who understand finance and those who don't is growing every year. Markets, crypto, artificial intelligence, they just require attention. You showed up today. You're on the right side of that gap. Let's make it count. Let's go.
Box office receipts just became a sharper trading signal than half of Wall Street research. The Odyssey just opened at $51 million day one, on track for a $150 to $200 million domestic run, and a global box office that turns into billions in downstream streaming, gaming tie-ins, and merch. Same week, the S&P ticks down about 1%, Nvidia gets slapped not at 2.2%, and everyone screams top like it's a reflex, not a thought. Meanwhile, the sports world unloads pure data. Kimi Antonelli takes pole over Max Verstappen. The Open leaderboard reshuffles quarter by quarter, and Vegas books reprice odds in real time as every lap and every hole produces new information. Here's the tension. The market worships lagging earnings and stale macro headlines while ignoring live entertainment data that tells you where actual humans spend actual money right now. Look at this pattern. Massive opening for a myth-heavy blockbuster in a year everyone whines about content fatigue. That $51 million isn't just studio cash. It's proof the middle class still pays for spectacle when it hits the right nerve. Escapism, plus recognizable IP, plus theatrics. Now overlay that with the growth of alternative tickets. You don't just show up at a theater or a race. You show up in options volume on DraftKings, FanDuel, ticket brokers, sports merch, fantasy pools, and soon, tokenized slices of intellectual property. Signal 2, live sports volatility. In Formula One, Antonelli beating Verstappen to pole by 0.317 seconds instantly flips sportsbook exposure, ad pricing, and future race narratives. At the Open, half the leaderboard churns every few holes. Data enters the system, odds change, sponsorship eyeballs move, and yet most investors stare at a static S&P chart like monks reading a dead scripture. Signal 3, wildfires and geopolitics. Forbes talks wildfire smoke and health advice. WSJ talks Turkey dumping a Russian air defense system to beg back into US F-35s. Translation: outdoor events risk gets repriced, insurance gets uglier, indoor and digital entertainment gets more valuable, and defense spending stays on a permanent slow boil. Here's the cliffhanger. All three signals point to one ugly truth. Your boring entertainment index fund is secretly a leveraged bet on attention, volatility, and weather. Nobody ties these together because they all live in different silos: film nerds, sports degenerates, ESG climate whiners, and defense hawks. I don't care about silos. I care about cash flows and where they're accelerating. The mechanism is simple. Attention equals pricing power. Volatility, derivatives. Derivatives plus attention is recurring revenue that doesn't care about your recession takes. When a movie like The Odyssey blows past expectations, it doesn't just feed Disney or whoever owns it. It feeds a whole stack: theater chains, merch licensors, streaming platforms, ad buyers. Every surprise upside in opening weekend is a live stress test of consumer discretionary demand. Now compare that to sports. F1 qualifying and majors like...
Does what you just heard shift something for you? That feeling, that need to know more, is exactly the right reaction. Most people never get there. You just did. Let's keep going.
The Open moved billions in betting handle in a weekend. Book set odds, adjust in real time, hedge risk, and milk vig. That's a pure options business built on human emotion and short-term chaos. Those sports eyeballs bleed into sponsorship deals, media rights, streaming bundles, merch drops. Everything trad finance calls non-correlated is actually chained to the same raw variable, where attention spikes this week. Then layer in wildfire smoke and climate chaos. Outdoor events get pricier to insure and harder to run. Fans retreat indoors, screens win. Result: the economic value of an IP that doesn't care about weather, a movie universe, a racing series, a golf brand, an esport, goes up relative to things that burn, flood, or choke. So here's the verdict you're not hearing on CNBC. The real defensive sector now isn't utilities or bonds. It's repeatable attention machines with built-in betting and derivatives. You learn one thing today. Box office, sports, and climate headlines are not noise. They are forward indicators for the cash flows of attention factories. Mechanism. 1. Big openings and viral sports moments prove fans still pay for curated spectacle even when they claim they're broke. 2. Every unit of attention spawns leverage. bets, options, sponsorship ladders, subscription tiers. 3. Climate and geopolitical chaos shove more activity indoors and on-screen, juicing this whole complex over time. What do you do with this? Not financial advice, but here's the truth. First, stop thinking of entertainment stocks as cute consumer plays. Start thinking of them as structured products on human attention. You want companies that own IP universes, plus distribution, plus some exposure to betting, fantasy, or rights trading, not just a one-hit movie studio. Second, track real-time entertainment data as leading indicators. Box office surprise beats, record viewership for races or majors, betting volume spikes. These are faster tells than next quarter's earnings. Treat Variety, Motorsport, and Golf Channel like you treat CPI prints as macro data on behavior. Third, build a tiny, focused attention stack in your portfolio instead of spraying into every media ticker. One anchor that owns IP and distribution, one that monetizes volatility, sportsbooks, derivatives, and one sleeper play exposed to indoor entertainment whenever the real world catches fire. Literally. You're not a spectator. You're either the house or the mark. Stop pretending your index fund is neutral. It already leans toward attention machines. You just don't admit it. This is not financial advice. But the next time you see a monster opening weekend, or a race upset, or a major leaderboard swing, don't just refresh the highlights. Ask, who owns the rights to this chaos? Who sells the bets on it? And who rents the screen I'm staring at? Those 3 answers tell you more about the future of your money than another boring Fed speech. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's a wrap for today on Dr. Fred Markets. I hope this gave you something to think about, a new angle, a clearer picture, a better question to ask. Remember, this is not financial advice. Do your own research, always. If this video added value to your day, subscribe. It's free, it takes 2 seconds, and it's the best way to support this work and keep it free for everyone. You'll also find every video as a full article on the blog, drfredmarkets.com, and the newsletter is in the bio. I'm Dr. Fred Markets. See you in the next one.